Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean,
Envision awakening to a life where your monetary concerns are a relic of the past, the expenses are settled, and the existence you've always dreamed of is now a reality. And do you know what made it all feasible? The remarkable strength of dividends. Were you aware that in 2020, the S&P 500 corporations disbursed over $58 billion in dividends monthly to their stakeholders? What if I informed you that historically, dividends have constituted a significant portion of the stock market's overall return? That's correct. A staggering 42% on average. So the subsequent question is, how can we utilize this extraordinary wealth-creating instrument to secure our monthly disbursement of $4,400? Stay tuned, because we're about to unveil the transformative strategies to accomplish it. Today, we embark on an expedition guided by the insights of a legendary figure in finance, Warren Buffett, to discover the swiftest route to attaining financial liberty. Our objective, to transform your investments into a consistent stream of revenue through dividends, with the ultimate aim of securing a monthly disbursement of $4,400. So let's delve right into the presentation. To commence, let's comprehend what dividends are and why they're vital for attaining financial autonomy. As the legendary investor Warren Buffett once remarked, "If you don't discover a method to earn money while you slumber, you will labor until you perish." Dividends are your passport to earning money while you rest. And here's how it functions. When you invest in a company's stock, you essentially become a partial owner of that enterprise. Now, when that enterprise generates a profit, which we aspire it does, it has a choice regarding what to do with those earnings. One of the options is to allocate a portion of those profits to its shareholders, and this allocation of profits is what we refer to as dividends. Dividends are typically disbursed on a regular basis, often quarterly, but some companies do it monthly or annually. They're usually in the form of cash, although they can also be in the form of additional shares of stock, known as stock dividends, or dividend reinvestment plans. So in summary, dividends are your portion of the pie. When a company shares its profits with its shareholders, they can be a consistent source of income for investors, making them an essential instrument for accumulating wealth and achieving financial independence. It's a tactic that Warren Buffett himself has employed to amass wealth over the years. Well, the answer is, I do believe in dividends in numerous scenarios, including many of the corporations in which we possess stock. Warren Buffett also underscores the importance of constructing a robust portfolio. He states, diversification is protection against ignorance. It makes little sense if you know what you're doing. We had more reason to retain all of our earnings. If See's Candy were an independent company, we would simply distribute a lot of the earnings, practically all of the earnings, in dividends, just like we do now, except it goes to Berkshire. We prefer our companies in which we have investments to remit the funds they can't utilize effectively in their own business. In some cases, that's 100% of what they earn. In some cases, it's 0% of the earnings. We own some stocks that don't distribute any dividends. So how do we construct a formidable dividend portfolio? Constructing a dividend portfolio that can endure over time requires a well-conceived strategy. Let's deconstruct the key elements that will assist you in creating a powerful dividend-generating machine, just as Warren Buffett advocates. Number 1, selecting dividend-paying stocks. One of the initial steps is to meticulously select dividend-paying stocks. Seek out companies with a history of stable or increasing dividend disbursements. These are often found in sectors like consumer staples, utilities, and healthcare. Research is your ally here. Comprehend the company's financial health, its competitive advantage, and its capability to generate cash flow to sustain dividend payments. Number 2, diversification. Diversification is a concept dear to Buffett's heart. It signifies spreading your investments across different sectors and industries to mitigate risk. Don't place all your eggs in one basket. A well-diversified portfolio is more resilient to market fluctuations. Remember, while dividends can provide revenue, the value of your investments can also rise or fall. So diversification is your safety net. Number 3, long-term perspective. If you had a punch card with only 20 punches and you weren't going to get another one for the rest of your life, you would deliberate a long time before every investment decision. You would make prudent ones, and you'd make significant ones, and you probably wouldn't even use all 20 punches in your lifetime. But you wouldn't need to. Buffett is renowned for his long-term approach to investing. He once said, "Our favorite holding period is forever." When it comes to dividend stocks, this long-term perspective is invaluable. Dividend revenue can compound over time, especially if you reinvest those dividends back into your portfolio. This snowball effect can significantly enhance your income down the road. Number 4, assessing risk. Another Buffett principle is to steer clear of companies with excessive debt or those that frequently cut dividends. These could be warning signs for your portfolio's stability. Focus on enterprises with a robust balance sheet and a history of enduring economic downturns. Number 5, monitoring and adjusting. Lastly, regularly evaluate your portfolio. Companies can evolve and economic conditions can shift. Make modifications when necessary. Ensure your portfolio continues to align with your financial objectives by adhering to these principles. You can construct a formidable dividend portfolio that has the potential to provide you with a consistent stream of income and assist you in achieving your financial goals. Now let's get practical and calculate how you can actually achieve your goal of living off dividends. We'll break down the steps and strategies you can implement to reach that magical $4,400 per month in dividend income. Remember, the objective here is to make your money work for you, just as Warren Buffett has emphasized over the years. Blue chip stocks, where we owned or even diversified ETFs, we wanted them all to be compounding, in effect be compounding machines. That's why people entrusted us with capital. That's why we invested our own capital. Let's delve deep into the first strategy on our journey to living off dividends, investing in blue-chip dividend stocks. This strategy is akin to building a strong foundation for your financial house. Blue-chip dividend stocks are the cornerstone of many successful investment portfolios. These companies are typically well-established giants in their respective industries, known for their financial stability, solid track records, and consistent dividend payments. What makes them particularly appealing to income-focused investors is their reliability. Blue-chip stocks tend to weather economic storms better than their smaller, riskier counterparts, making them a secure source of dividend income. In the words of Warren Buffett, the most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd nor against the crowd. I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically. Buffett's excellent advice underscores the importance of discipline and long-term thinking when it comes to investing in blue-chip dividend stocks. Rather than chasing short-term market trends, focus on companies with proven resilience. These well-established companies often have competitive advantages, substantial market shares, and a history of consistently rewarding their shareholders with dividend payments, often for decades. By incorporating blue-chip dividend stocks into your portfolio, you're laying the groundwork for a reliable stream of income that can help you achieve financial independence. These stocks provide stability, income, and the potential for long-term capital appreciation. Hence, investing in blue-chip dividend stocks aligns perfectly with Warren Buffett's philosophy of seeking quality investments and holding them for the long haul. It's a time-tested strategy that can put you on the path to living off dividends and achieving your financial goals. So consider adding some of these rock-solid dividend payers to your investment portfolio today. Our second strategy for achieving financial independence through dividends is to invest in dividend growth stocks. Unlike the stable blue-chip stocks we discussed earlier, dividend growth stocks offer a unique advantage. They not only pay dividends, but also consistently increase them over time. Warren Buffett's wisdom echoes in this strategy. The best investment you can make is in yourself. In the context of investing, this translates to seeking out companies that continually invest in their own growth and are committed to increasing their dividend payments. Dividend growth stocks are often found among companies that operate in industries with substantial potential for expansion or those with innovative products and services. These firms prioritize reinvesting their earnings into research, development, and expansion, all while rewarding their shareholders with rising dividends. The appeal of dividend growth stocks lies in their compounding power. As these companies increase their dividends year after year, the income you receive grows, not just in dollar terms, but as a percentage of your initial investment. This compounding effect can significantly accelerate your path to financial independence. While dividend growth stocks may not offer the highest initial yields, their long-term potential to generate substantial income is unparalleled. These stocks reward investors who understand the value of compounding and are willing to let time work in their favor. As your investments grow, so does your income, making it a potent strategy for those looking to transition to a life funded by dividends. So, investing in dividend growth stocks aligns perfectly with Warren Buffett's emphasis on lifelong learning and a long-term perspective. By putting your money into companies that prioritize growth and increasing dividends, you're not just investing in stocks, you're investing in your financial future. So consider incorporating some of these promising dividend growth stocks into your portfolio to pave the path towards living off dividends. Strategy number 3. On our journey to achieve financial independence through dividends introduces an intriguing variation: covered call exchange traded funds, ETFs. These investment tools can be a potent addition to your dividend income strategy. Warren Buffett's renowned advice guides us in this approach. The stock market is designed to transfer money from the active to the patient. In the realm of covered call ETFs, patience can indeed be a virtue. So what are covered call ETFs and how do they function? Covered call ETFs are a distinct type of investment vehicle that merges stocks and options. These funds maintain a portfolio of dividend-paying stocks while concurrently selling call options on those same stocks. This approach generates supplementary income for investors, potentially enhancing your monthly dividends. Here's how it operates. Covered call ETFs typically encompass a selection of high-quality dividend-paying stocks. These stocks form the foundation of the ETF's portfolio. The ETF then sells call options on the stocks it holds. A call option gives the purchaser the right, but not the obligation, to acquire shares of the underlying stock at a specific price, the strike price, within a set period. By selling these call options, the ETF collects premiums from buyers. This premium income is distributed to investors in the form of dividends. However, selling call options also limits the potential upside of the stocks in the portfolio. If the stock price escalates significantly, the ETF may have to sell those shares at the agreed-upon strike price, forfeiting additional gains. Covered call ETFs are crafted for investors who are willing to exchange some potential upside for consistent income-generating dividends. These ETFs are especially appealing for income-focused investors who wish to augment their dividend income without assuming excessive risk. They provide a means to extract more income from your existing holdings without making significant changes to your investment strategy. Now let's look at some tangible examples of covered call ETFs with a trailing yield over 12 months, yielding approximately 12%. Global X S&P 500 Covered Call ETF, XYLD. XYLD adheres to an index that tracks the S&P 500 stocks and sells covered call options on them. This strategy aims to provide investors with attractive yield potential while maintaining exposure to large-cap US stocks. ProShares K1 Free Crude Oil Strategy, ETF, OILK. OILK endeavors to provide exposure to crude oil by investing in a combination of futures contracts and covered call options on crude oil futures contracts. This unique approach can offer significant income potential for those interested in commodities. iShares MSCI Brazil ETF, EWZ. While not a covered call ETF itself, EWZ is an example of a traditional ETF that invests in Brazilian stocks. You can explore covered call ETFs that focus on specific international markets like Brazil to add diversification to your dividend strategy. In essence, covered call ETFs offer a unique method for generating income from your investments. By adhering to Buffett's advice to be patient and understanding the trade-off between income and potential upside, you can use these ETFs as a valuable resource in your quest to live off dividends. Consider integrating them into your portfolio alongside your other dividend strategies to diversify your income sources and potentially expedite your path toward financial independence. Now let's do some simple math to see how you can reach the goal of $4,400 per month through covered call ETFs with a 12% yield compared to the traditional dividend investing method. If you aim to generate $4,400 per month from covered call ETFs with a 12% annual yield, first you need to calculate the annual income required. The annual income required equals $4,400 per month times 12 months, equaling $52,800 per year. Now divide the annual income required by the yield percentage to determine the total investment needed. Total investment needed equals $440,000. So, you would need to invest approximately $440,000 in covered call ETFs with a 12% yield to generate $4,400 per month. Let's compare this to the traditional dividend investing method, assuming a more typical dividend yield of around 3%, which is common for blue chip stocks. Annual income required is $52,800 per year. Total investment needed equals annual income required divided by yield percentage. So total investment needed equals $52,800 divided by 0.03 or 3%, which equals approximately $1,760,000. With a 3% yield, you would need to invest approximately $1,760,000 in traditional dividend-paying stocks to generate the same annual income of $52,800. So the conclusion from the math: if you want to make $4,400 a month with covered call ETFs with a 12% yield, you would need to invest $440,000. But if you want to make the same $4,400 a month from traditional dividend stocks with a 3% yield, you would need to invest $1,760,000. As you can see, the traditional dividend investing method requires a significantly larger investment to achieve the same income level as covered call ETFs with a 12% yield. Covered call ETFs can provide a higher yield, making them potentially more appealing to investors looking to generate income with a smaller initial investment. However, it's essential to consider risk factors. as covered call ETFs may have limited capital appreciation potential compared to traditional dividend stocks. Additionally, diversification and individual financial goals should play a significant role in determining your investment strategy. Always consult with a financial advisor to tailor your approach to your specific needs and risk tolerance. In conclusion, whether you choose the power of covered call ETFs with a 12% yield or opt for the traditional dividend investing method, remember that your journey to living off dividends is not a sprint, but a marathon. The path you choose should align with your financial goals, risk tolerance, and investment horizon. Both strategies have their merits, and the key is to remain patient, stay informed, and stay invested. So, which method resonates with you? Share your thoughts in the comments below.